Hello. Over the last few months and in our last interview, we warned that an equity sell-off could materialize, and it has happened over the last few weeks. Now, the short term seems a bit oversold, and we are currently seeing a slight bounce, but we believe that the dynamics, which are now in play, could lead the markets lower again, first into mid-late November, and then possibly into early next year. In general, we believe that the tide has turned on equity markets and that they could head lower, possibly over the next 12 to 18 months. We first look at the S&P 500 on a weekly chart or the perspective over the next few quarters. We had warned of strong levels of exaggeration over the last few months as our envelopes were touching each other, which is a sign of market stress, as our risk index was very much into the red overbought situation, and that our impulsive targets to the upside have been achieved, impulsive up done. On the daily graph, or the perspective over the next few months, the reversal now seems clear, and it's been quite impressive. It's made it below our corrective targets to the downside, and is now eyeing our impulsive targets to the downside between 2,500 and 2,400. These targets could materialize over the next 3 to 4 months. On the risk index, we're still moving lower and we're not yet oversold. So although we can see a slight bounce, it is too early in our view to get back into the market. If we look at the hourly graph, we can see this intermediate oversold condition. Our risk index has reached the oversold zone, our impulsive targets to the downside have been reached, and our envelopes are touching each other. Such bounces usually last 4 to 5 days. So to summarize, we were in an exhausted upside situation on the weekly graph, calling the end of a long-term uptrend. The daily graph has reversed down and has even turned impulsive to the downside and is showing much more risk over the next 3 to 4 months. And the hourly has reached an intermediate low, could bounce a bit, but this is only a short-term bounce. Now, if we look at Europe, the downtrend on the weekly graph is already well in place. And it is showing aggressive targets to the downside, possibly towards 2,600 and possibly even down to 2,200. This means that the full bull market from 2016 to 2017 should be retraced and prices should even sink below it. The risk index didn't make it into the overbought zone, but it is rolling over again and our envelopes are already turning down. This is a strong downtrend with much more potential to the downside over the next few quarters. On the daily graph, we are also in a strong downtrend. It is showing signs of exaggeration and perhaps more than on the S&P because it has been going on for a while longer. Yet the risk to the downside over the next few months is still quite compelling. We could see it moving down below 3,000 over the next 2 to 3 months. On the daily graph, we reach an intermediate low, and we should also see a bounce over the next few days, possibly into mid-end this week. Our impulsive targets to the downside had been reached, and our risk index is oversold. Yet we believe that this low should be an intermediate one. Summarizing, all three frequencies are showing more potential to the downside and still in downtrends. And so for the time being, if you want to play the rebounds, do it very, very carefully. Now, one of the culprits of this acceleration of equity markets this year has been China, and China has been moving down since earlier this year. Its downtrend on the weekly graph is still well in place, and it could lead us below 2,000 over the next few quarters, so still quite a lot of risk to the downside. The daily graph is oversold at the moment, has reached its target, and both our envelopes are touching each other. That means that we could see a slight consolidation here over the next few weeks, but in general, we believe that China won't be different than other equity markets, and we are very wary of its path going forward, especially towards next year. The hourly graph has already seen a rebound last week. It's reached its corrective targets to the upside. We expect it to work its way through over the next week towards these corrective levels, and by end of this week, early next, start resuming down with the other markets. It's also interesting to look at defensive sectors versus the market, and here we look at the consumer staples ETF XLP versus the S&P 500 ETF SPY. And what we could see here is that over the last 2 years, defensive sectors have widely underperformed the market, but they have reached our our oversold situation on the risk index over this long-term chart, as well as our targets, and maybe starting to reverse up. Now we could see the strength of this defensive move on the daily graph, where XLP actually shot up versus the S&P 500 over the last few weeks. It has now turned impulsive, and we could see quite a bit of additional potential to the upside on a relative basis over the next few months. This move is not yet overbought, so it has some more way to go to the upside. Shorter term, we could also see some exaggeration here. We are close to the overbought zone, our envelopes are touching each other and our targets have been reached. So we could probably see a week of consolidation here, which would correspond to a rebound in the markets. But then, as we look at the daily, we believe that the ratio should reaccelerate up over the next few months. Finally, we look at a bellwether, which we believe is important at the moment for mostly passive investment and equity markets in general. We look at the stock of BlackRock, which is the biggest ETF provider in the world. And what we could see here is that following a huge performance in 2016-2017, BlackRock has started to reverse down and has recently broke through our corrective targets to the downside and is now showing aggressive targets to the downside into the end of next year. The daily graph has seen a very strong sell-off since the beginning of the month. It's oversold at the moment, and our targets have been reached. But we could expect an intermediate bounce here, but given the strength of this long-term downtrend, it will probably be intermediary. Shorter term, it is still finding problems to stabilize on the hourly graph. There's still some potential to the downside, but our risk index is close to oversold, so we could also see a slight bounce here. But in general, all three trends are still heading lower, and possibly first into November, and then into early next year, and possibly into the end of 2019. So if you want to play the rebounds on equities, please do it very carefully, and we believe there are more an opportunity to take off more weight out of equities and place it possibly into cash or perhaps into treasury bonds. Thank you very much, and have a good week.